There's a pattern in economic history that repeats with almost mechanical precision. Not every decade, not at random, but when certain conditions line up perfectly. Extreme asset valuations, record debt levels, excessive leverage, a widespread belief that this time is different, and then a trigger event that forces liquidation. Those conditions were present in 1929. They were present in 2008, and right now in 2025. Every single one of those conditions is present again. Not just similar conditions, practically identical conditions. The stage is set, the players are in position, and if history is any guide, the next big crash lands in late 2026 or early 2027. This isn't prophecy. This isn't doom for the sake of doom. This is pattern recognition. I'm going to walk you through how crashes actually unfold, who gets wiped out, who makes a fortune, and why the 2026 crash could hit harder than 1929 and 2008 combined. Because the scale is bigger, the leverage is higher, the connections are tighter, and the people in charge have already used most of their ammunition fighting the last crisis, leaving very little left for the next one. Think of this as a documentary about a crash that hasn't happened yet, built on a pattern that has happened twice before with devastating accuracy. The mechanisms are the same, the timeline is surprisingly predictable, and the outcomes, who gets destroyed and who gets rich, follow almost the exact same script every time. Let's start with where we are right now. January 2025, the setup. Every major crash begins with a bubble. Right now, we're in the biggest everything bubble in history. It's not just stocks. Real estate in major cities is at record highs. The median home price in America is about $420,000. The median household income is around $75,000. That's a price-to-income ratio of roughly 5.6 to 1. Historically, sustainable ratios sit closer to 3 to 1. At 5.6, housing is almost 87% overvalued relative to incomes. In 2006, right before the housing crash, the ratio peaked at 5.0. We're above that now. Corporate debt is at record levels. Non-financial corporate debt in the U.S. is around $13.5 trillion, about 72% of GDP. In 2007, before the last crisis, it was closer to 43% of GDP. Corporations are more leveraged now than they were in the lead up to 2008. Government debt is around $36 trillion. Roughly 120% of GDP. Interest payments alone are pushing toward $1 trillion per year. Consumer debt, credit cards, auto loans, student loans is over $17 trillion. Total U.S. debt, government, corporate, household, financial sector is above $90 trillion. That's more than 320% of GDP. Every part of the system is over-leveraged at the same time. This is the everything bubble. Everything is expensive. Everyone is in debt. And almost everyone believes prices will just keep going up. Why do they believe that? Because for the last 15 years, since 2009, the Federal Reserve has trained them to. Every time markets stumbled, the Fed cut rates or printed money. Quantitative easing, QE1, QE2, QE3, COVID stimulus. Trillions pumped in. From 2008 to 2022, the Fed printed over $8 trillion. That money flowed into financial assets, pushing prices higher and higher. Investors learned a simple rule: buy the dip. The Fed will save you. That conditioning created massive moral hazard. No one is really afraid of risk anymore because they believe the central bank will always step in. But there's a problem. The Fed has already fired most of its shots. Interest rates sat at zero for about a decade. There's no meaningful room to go below zero. The balance sheet exploded from about $800 billion in 2008 to around $9 trillion in 2022. There's limited space to expand it further without reigniting serious inflation. which already happened in 2021 and 2022. To fight that inflation, the Fed hiked rates from 0% to about 5.5% in a year and a half, the fastest increase in roughly 40 years. That stopped inflation, but created new problems. Higher rates make all that existing debt much more expensive. Corporate bonds issued at 3% have to be refinanced at 7%. Mortgages locked in at 3% now face a world where new loans are 7%. The debt burden becomes crushing, and the Fed can't simply slash rates back to zero without risking another inflation wave. They're trapped. Rates too low, inflation returns. Rates too high, the debt becomes unpayable. There is no easy path out. That's the setup. Maximum valuations, maximum leverage, and a Federal Reserve that has already used most of its tools and has very little left for the next crisis. Now let's compare this to 1929 and 2008, because the pattern is almost the same. In 1929, the stock market had soared roughly 400% from 1924 to 1929. A 5-year boom. Margin debt, money borrowed to buy stocks, reached around 10% of GDP. Everyone was leveraged. Everyone believed stocks only go up. Economists literally talked about a permanently high plateau, a new era where big crashes were impossible. Then October hit. Over the next 3 years, the market fell around 89%. In 2008, housing prices had doubled from 2000 to 2006. Mortgage debt hit roughly 100% of GDP. People used subprime loans and exotic mortgages to buy homes they couldn't really afford. The belief was that housing prices never fall nationwide. Then the subprime loans started to default. The entire financial system started to crack. The S&P 500 dropped about 57%. In both cases, the setup was the same. A massive asset bubble, excessive leverage, a widespread belief that the boom was permanent. Then a trigger event. Then cascading liquidations. The 2026 crash, if it plays out, will follow that same pattern. We already have the bubble. We already have the leverage. We already have the belief that the Fed simply will not allow another crash. All that's missing is the trigger. And there are several likely candidates. Let's go through the 3 most probable triggers and how each one could start the chain reaction. Trigger 1. A commercial real estate collapse. This is the most likely because it's already in motion. Office buildings across the country are sitting 40 to 50% vacant thanks to remote work. Companies that used to lease 5 floors now lease 2. This isn't going back to 2019 norms. Remote work is here to stay. These buildings were financed with cheap mortgages at around 3%. Those loans are expiring and have to be refinanced at 7% or 8%. A building that barely covered its debt at 3% is instantly unprofitable at 7%. The math stops working, so owners walk away. We've already seen large firms simply hand properties back to lenders because the loans are now worth more than the buildings. Between 2025 and 2027, over $2 trillion in commercial real estate loans are set to mature. If even 30% of those default, that's roughly $600 billion in losses. And who holds a huge chunk of those loans? Regional and community banks. Many of these smaller banks have 20 to 40% of their loan books tied up in commercial real estate. When those loans go bad, the losses eat into their capital. Once capital falls below regulatory minimums, regulators shut them down. We've already had a preview. Silicon Valley Bank, Signature Bank, First Republic, all failed in 2023. On the surface, those collapses were blamed on interest rate risk, but underlying all of it is the same story: long-dated assets losing value as rates rise, including real estate. If commercial real estate defaults surge through 2025 and 2026, we could see dozens of regional bank failures, and bank failures always trigger panic. Trigger 2, a major corporate bankruptcy or a sovereign debt default. In 2020 and 2021, hundreds of corporations issued cheap debt at ultra-low interest rates. That debt is maturing now. They must roll it over at much higher rates. Some companies simply won't be able to handle that jump. If a big Fortune 500 company can't refinance and defaults on its bonds, it could spark a wave of fear. Bond investors rush to sell other corporate bonds. Yields surge. Borrowing becomes nearly impossible. Any company that needs to refinance suddenly can't, and more defaults follow. That's how you get a 2008-style credit crisis. Sovereign debt defaults work the same way, but on a bigger scale. If a large emerging market, like Turkey, Argentina, or Pakistan, defaults on dollar-denominated debt, investors immediately start questioning other countries' ability to pay. They sell emerging market bonds, capital flees, currencies crash, more defaults follow. Banks in Europe and the U.S. that lent to those countries take big losses. The problem spreads from emerging markets to developed markets. One big default can set off a global chain reaction. Trigger 3, a geopolitical shock, war, a new pandemic, a large-scale terrorist attack, a contested election, anything that spikes uncertainty and volatility and forces people to sell assets just to raise cash. We saw this in early 2020. COVID wasn't an economic issue at first. It was a health crisis. But uncertainty drove panic selling. People and institutions liquidated whatever they could. If something similar happens again, a conflict over Taiwan, a major Middle East escalation that disrupts oil supplies, or serious political chaos around a U.S. election, you could see the same rush to cash and the same violent sell-off. Any of those three could be the trigger, but the cause underneath is always the same: overvaluation, too much leverage. The specific trigger is almost irrelevant. Once liquidation starts, the mechanics take over, and those mechanics are brutal, predictable, and devastating. Let's walk through what happens after the crash begins. Based on what we saw in 1929 and 2008, the timeline speeds up or slows down depending on how fast liquidation happens, but the sequence is almost always the same. Phase 1, the initial shock. The trigger event happens. Markets drop 10 to 15% in a few days or weeks. Investors are shaken, but not terrified. Most people see it as a buying opportunity. Buy the dip. The Fed will step in. Stocks are on sale. News outlets bring on analysts who say fundamentals are still strong. This is temporary, and that it's a healthy correction. In 1929, the initial shock was Black Thursday. The market plunged double digits in a single day, but big bankers stepped in, bought stock, and calmed things down for a moment. In 2008, the initial shock was the collapse of Bear Stearns in March. The Fed helped arrange a rescue deal. Markets dropped, but then stabilized. People called it a one-off event. In a 2026-style scenario, the initial shock could be a major bank going under or a wave of corporate defaults. Markets slide 10 to 15%. The Fed issues statements saying they're monitoring conditions, the system is strong, and liquidity will be provided if needed. Investors buy the dip. Stocks bounce partway back, but the crack in confidence is already there. Phase 2, the false recovery. After the first hit, markets either stabilize or even climb for a while. This can last weeks or months. It's the most dangerous stage because it convinces people the worst is over. In 1929, after the first crash day, the market rallied for a bit. By early November, prices were nearly back to pre-crash levels. People who sold felt foolish. People who bought the dip felt smart. Then the real collapse began. In 2008, after Bear Stearns was saved, markets drifted sideways for months. By summer, the S&P 500 was only down about 10% from its peak. Commentators talked about how the crisis was contained. Then Lehman Brothers failed in September, and the bottom fell out. In a 2026 scenario, you might see the same pattern. An initial scare, a partial recovery, the media calling the worst over, the Fed doing a minor rate cut or liquidity injection. Under the surface, though, the problems keep spreading. Defaults rising, banks tightening lending, stress building. Phase 3, the cascade. This is the real crash. Forced selling, margin calls, panic. In 1929, this cascade lasted from late 1929 to mid-1932, with stocks ultimately down nearly 90%. In 2008, it ran from autumn 2008 to spring 2009, with the market losing more than half its value. In a 2026 style crash, the cascade could run 12 to 18 months, with a fall of 50 to 70% from the peak. Here's how that cascade works. First, leveraged investors get margin calls. Anyone who borrowed to buy stocks starts getting squeezed as prices fall. If stocks drop far enough, their equity is wiped out. Brokers demand more collateral. If they can't provide it, brokers sell their positions automatically. That forced selling pushes prices even lower. Next, institutional investors face redemptions. Mutual funds, pension funds, hedge funds. When their portfolios fall and clients get scared, people pull money out. Funds have to raise cash, so they start selling into a falling market. More pressure. Then algorithmic trading piles on. High-frequency and trend-following algorithms detect the downtrend and start selling too. Stop-loss orders trigger more selling. Circuit breakers halt trading temporarily, which sometimes makes people even more panicked when the market reopens. Liquidity dries up. If everyone wants to sell and almost no one wants to buy, there are no bids. Stocks start gapping down 10, 20, 30% in brutal moves because there's simply no buyer at a normal price. It stops feeling like a decline and starts feeling like a collapse. At the same time, credit markets start freezing. Banks and lenders get scared. They don't know who will survive and who won't. So they pull back on lending. Companies that need to refinance or raise cash suddenly can't. They default. Banks that lent to them take hits. The cycle feeds on itself. As this is happening, the economy is sliding into recession. Trillions in paper wealth vanish. When people feel poorer, they spend less. When they spend less, companies earn less. Companies respond by cutting costs, meaning layoffs. Unemployment rises sharply. Those newly unemployed workers cut spending even further. The downturn turns into a deep recession, or worse. Phase 4, maximum panic. This is the real bottom. The moment when fear is so intense that people sell anything just to feel safe, no matter the price. In the Great Depression, this was the early 1930s. Stocks obliterated, unemployment sky high, banks failing by the hundreds. In 2009, this was the moment when major banks looked insolvent and the government had to step in with bailouts. In a future crash, the panic bottom might come sometime in late 2027 or early 2028. You could see the S&P go from around 6,000 to something like 2,500 or below. Unemployment jumping to around 10%. Multiple banks either failing or needing government rescue. This is the moment of maximum fear, and for a small group of people, maximum opportunity. Phase 5, the slow recovery. This starts when the government and central bank finally unleash everything. Huge stimulus packages, rate cuts back to zero, massive asset purchases, bailouts, guarantees, new programs. In the 1930s, this looked like the New Deal. Job programs, reforms, safety nets. It took decades for the market to fully recover. In the 2008 crisis, the recovery was faster thanks to aggressive monetary and fiscal response. Markets hit new highs within a few years, even though the real economy lagged behind. In a 2026 style crash, you'd likely see an even bigger response. Rates back to zero, multiple multi-trillion-dollar stimulus bills, huge expansions of government programs. But the starting point is worse. Government debt is already around 120% of GDP. Pushing it to 150% or 180% through repeated bailouts and stimulus raises hard questions. Do you raise taxes, slash spending, inflate the debt away? None of those options are painless, so the recovery could feel weaker, slower, and more chaotic. Markets might not revisit their 2025 peaks until the early 2030s. That's the five-phase pattern: initial shock, false recovery, cascade, panic bottom, slow recovery. Now, who gets destroyed in this process and who ends up rich? Every major crash is basically a massive wealth transfer. Wealth doesn't vanish, it moves. Who gets crushed? First, the middle class holding stocks and homes. In 1929, middle-class families who had put their savings into the stock market saw their portfolios obliterated. In 2008, ordinary homeowners who bought at the peak lost 40 to 50% of their equity. Many ended up underwater, owing more than their homes were worth. In a 2026 crash, middle-class households with retirement accounts could see their balances cut in half or worse. A lifetime of saving gone in a year or two on paper. Homeowners who bought recently at elevated prices could see drops that trapped them, unable to sell without taking a huge loss. Retirees are especially vulnerable. Someone retiring with a big nest egg suddenly sees it shrink dramatically, and they don't have the time or earning power to rebuild. Small business owners get hit too. When consumer spending drops, small businesses lose customers. They struggle to pay rent, payroll, and loans. Many close down. In the last crisis, tens of thousands of small businesses disappeared. The next one could be worse. Leveraged investors are wiped out. Anyone who borrowed heavily, using margin, using loans to buy rentals, using leverage to chase returns, faces forced liquidation. They can end up not just losing investments, but owing money they can't repay. Bankruptcy, destroyed credit, years to recover. Now, who profits? Crashes always create a small group of big winners. People holding cash and safe assets do well. If you sold early or just never chased the bubble, your purchasing power rises when everything else falls. You can scoop up assets at bargain prices when everyone else is forced to sell. In past crashes, investors who held cash, gold, or short positions made massive gains. Some became legends for calling the crisis and positioning correctly. In a future crash, similar strategies will create the next generation of ultra-wealthy investors. Those with large cash piles can buy distressed assets, stocks, real estate, even entire companies, at a fraction of their former value. Distressed debt investors will buy the bonds of companies in trouble for pennies on the dollar, then profit when those companies restructure or recover. Real estate investors with cash can buy properties in bulk out of foreclosure, then ride the recovery in home prices and rents. Private equity firms and big funds with dry powder, uninvested capital, are already waiting for these opportunities. They've raised trillions specifically to deploy in a downturn. So the story is the same every time. The unprepared, over-leveraged middle class gets hammered. The already wealthy, well-positioned elite uses the crash to become even richer. This isn't theft in the legal sense. It's just how the cycle works. Crashes don't destroy wealth. They transfer it from those who don't understand the pattern to those who do. Now, let's compare 1929, 2008, and a potential 2026 crash side by side. What's the same? All three are driven by bubbles. In 1929, it was stocks. In 2008, it was housing. In 2026, it's stocks, real estate, bonds, pretty much everything all at once. Leverage is always at the core. Margin debt in 1929, subprime mortgages and exotic derivatives in 2008, record corporate, consumer, and government leverage now. The belief that this time is different is always there. In 1929, it was the idea of a permanently high plateau. In 2008, people claimed housing never falls nationwide. In our era, people believe the Fed simply won't let markets crash, that central banks have eliminated big bear markets. The mechanics of the cascade are always the same. Forced selling triggers more forced selling. Credit tightens, panic spreads. The system feeds on itself until it breaks. The wealth transfer is the same. Those heavily invested and leveraged get wiped out. Those who held cash, gold, or short positions profit. Those who buy quality assets at the bottom eventually come out far ahead. What's different this time? First, the scale. In 1929, the total size of the stock market and the global financial system was much smaller. In 2008, it was much bigger. Today, it's bigger still. Market cap, debt levels, derivatives, everything is orders of magnitude larger. Second, speed and connectivity. In 1929, information moved slowly. In 2008, it moved faster, but was still limited compared to today. Now, markets are hyper-connected. Algorithms trade in microseconds. News and fear spread globally in seconds. That can make the crash faster and more violent. Third, government capacity. In 1929, policymakers didn't fully understand the problem and responded late and weakly. In 2008, they had room to cut rates from around 5% to near zero and space to launch big stimulus programs. Today, we already start from a place of high debt and a huge central bank balance sheet. The response to the next crash will likely involve even bigger stimulus and more aggressive measures, but with less long-term effectiveness and more side effects, like inflation or currency issues. Fourth, the social and political consequences. In the wake of the Great Depression, you saw the rise of political extremism around the world. After 2008, you saw a surge in populism, protests, and polarization. Right now, wealth inequality is even worse. The middle class is more fragile. If a giant crash wipes out what's left of middle-class wealth, the political fallout could be intense. Protests, radical movements, deep mistrust in institutions. Now, what do you do with all of this? This is not financial advice. I'm not your financial advisor. But if you look at the historical pattern, certain strategies have consistently helped people survive and even benefit from crashes, reducing exposure to risky assets when valuations are extreme. Holding some portion of your wealth in cash or short-term safe assets. Owning a small allocation to things like gold that tend to do well when money is being printed. Making a shopping list of strong companies you'd love to own and being ready to buy them when they're on sale during maximum fear. Keeping your personal finances resilient, lowering debt, building an emergency fund, and protecting your income as best you can. Most importantly, preparing yourself mentally. Because the hardest thing to do in a crash is act rationally. When headlines scream, "End of the world," it feels insane to buy. When everyone else is panicking, it feels smart to sell. But historically, the people who understood the pattern, the ones who saw the setup, expected the crash, and prepared, are the ones who not only survived, but came out the other side in a much stronger position. Crashes don't come out of nowhere. They build slowly, then arrive suddenly. The same ingredients appear every time. Overvaluation, too much debt, blind faith that the boom will last forever. We are there again. The setup is complete. The pattern is repeating. Whether the crash hits in late 2026, early 2027, or on some slightly different date, the logic of the cycle doesn't change. The only real question is what you decide to do with that knowledge and which side of the next wealth transfer you end up on.